Australia's fourth largest major bank, National Australia Bank, today reported a cash profit of $6.64 billion, up 2.5% on the 2016 financial year. Although the headline number largely met forecasts, the market was a little underwhelmed by its progress on reducing costs. Just like the reaction to ANZ's results last week, the market sold the shares down, with NAB shedding 2.8%. To discuss his take on bank reporting season, as well as his insights into all the latest broker upgrades and downgrades, Rudy Philippek van Dijk, the editor of FNArena, joins me in the studio. Rudy, welcome to the program.
It is a pleasure.
Now, we've had ANZ last week, Macquarie last Friday, and National Australia Bank today. Westpac to come on Monday. How would you rate what we're seeing so far in terms of bank reporting season? Don't
forget, 2 days after Westpac, we get the Q1 update from Combank.
Right. Okay, yep.
Well, in short, the bank's not helping. I mean, if this market, I know a lot of people would like to see this market attacking the 6,000 mark for the ASX 200, not for all ordinaries. Well, then the bank's not helping. In
the main, you're saying they've been a little underwhelming. Is that what?
That's what I'm saying. Maybe it's a good to explain as well that I actually put a lot of emphasis on the banks in the Australian share market because obviously they have that weight. And on my analysis, you can use the banks as a gauge of risk appetite in the Australian share market. So in very simplistic terms, what I do is I look at the price targets that brokers set for bank shares. Banks are amongst the most covered stocks in the market, so everyone's always watching every day what they do. You compare that to the share prices, and historically there's quite a close correlation that when those share prices start moving past price targets, then you can talk about elevated risk appetite, and most of the time there's a retreat after that because what does tend to happen historically is that the banks come out with results, everyone goes like, good results, brokers up their targets, lift their forecasts, and that means that the share price actually can move higher.
But this hasn't happened this time.
Not earlier this year, and it's not happening now. And this is how I look at results and how, at share prices. In ANZ's case, the price target, the consensus price target, if you take all the brokers together, you calculate consensus, is actually now lower than where it was before the result. And the share price basically is already around that level, $30 something. So strictly taken, there's limited upside.
ANZ, of course, said though it just takes a while for its cost cutting to flow into the bottom line, and
they all have an excuse. They all have an excuse, but the bottom line is price targets are coming down, forecasts are coming down, share price is already where the price targets are, so limited upside. Look, today we have the NAB, and the NAB essentially did the same thing. Right?
Okay, so the 2 weeks since I last met, you've gone back into the glass half empty, haven't you?
I don't know if there's a glass, but when it comes to the banks, actually this is the theme, I think, that has characterized the share market this year. There's fund managers want to put money in the share market, they see limited upside in the top end of the market. As a result, more money is flowing to the second and the third tier. That's what we saw in October, that's what we've seen before. And irrespective of this market goes to 6,000 or not, everyone who owns A2 Milk or Blackmores or whatever couldn't care less whether this market goes to 6,000 because these guys are making 60, 70, 80% in a few weeks' time. And that is obviously also a result of that money flowing into second and third tier stocks.
I'll move on to Macquarie because Macquarie was quite the exception.
They were the exception, definitely. See, what Macquarie actually did, this is actually quite interesting. Macquarie had a rather sober outlook previously, and then came out and actually smashed expectations. And as a result, all the price targets of Macquarie have moved upwards. And there's now a wide, quite a broad group of price targets, which is on the other side of $100. Let's say 104, 105. There's a few brokers that have put 114 on the shares. Now, I think the share price is more likely to go to the 1415 mark than to the 114. You always have a few outliers, but see, if the other banks had done a Macquarie, then I would be more comfortable that this market would reach 6,000 soon. Now I don't think that's the case. Okay, let's move on to the retailers. Woolworths sales results. Yes. The big one there, I think, was the Big W
positive.
Yes.
What was your take on that, and how do you stack them up versus Wesfarmers?
Well, they obviously, momentum there has definitely turned. It has to be pointed out that momentum inside Woolworths was actually slowing as well. So also Woolworths is also experiencing a slowing.
Yep.
But the big surprise there was an unexpected positive sales return from Big W. However, and this is also what the analysts are thinking, they are thinking, yeah, but at what cost?
Yep.
There's a general expectation that Big W will remain loss-making, not only this year, but probably for years to come, multiple. And this could just be,
So I think bottom line, you're saying pretty fully valued is sort of how they're seen in retailers?
Exactly. The other thing is that it's now creeping up into the high 20s, and it's getting a little bit, less oxygen in the air.
We're just running out of time. Any standout upgrades or downgrades over the last week?
Well, Macquarie would be the standout, I think. As I briefly discussed with you off camera, there's more downgrades being issued than upgrades by stockbrokers. That usually doesn't help either, because the share market needs positive news, and that doesn't help either. The fact that the stockbrokers, again, they don't see that much upside in a lot of those stocks, and that's why they get downgrades, of course. Right? There's a broad convergence in the neutral camp at the moment.
Okay. And finally, a question I get asked a lot. People that have been held on positions in CSL and Cochlear had fabulous runs. Time to take profits, or how do you play those two stocks?
They're not the only ones. Well, I'm a shareholder in CSL, not in Cochlear at the moment, and I actually bought extra shares in CSL recently. That probably answers your question. Yes, shares can always retreat, of course. I do think that a stock like Cochlear, given the high valuation and given the fact that the share price is consistently well above price target set by brokers, you probably have to show a little bit more caution there, because retreats will come at some stage, and we've seen in recent days that, for example, an A2 milk can be down quite quickly. The same can happen and has happened with the likes of Appen, for example. It is not inconceivable that something like that can happen with the Cochlear. If it does happen with CSL, my response would almost be that I would buy extra shares in CSL, because I do believe that CSL is one of those stocks that looks expensive at face value, but underlying it actually isn't, and the share price will be a lot higher, I believe, in time to come.
Okay, so we've given a good tips there, Rudy, but we'll write those down. I think you're right about CSL, but like anything, you need to get appropriate advice. So with that caution, I'm going to thank Rudy Philippek van Dijk, the editor of FNArena. Thanks for joining us on Switzer.
My pleasure.
After the break, Roger Montgomery from Montgomery Investments joins the program. Find out his take on our share market.
This is Switzer, exclusive to Sky News Business.